All right, let's dive into something huge. We're talking about the high-stakes, global battle for control of the protein industry. And believe me, this isn't just about what you're having for dinner. It's a full-on war, fought in boardrooms and across entire continents. And the outcome? Well, it affects food security for billions of people. To really get a sense of the scale here, let's just start with one number. $223 billion. I mean, just let that sink in. That's the combined yearly revenue from fresh meat and protein for just the top 10 companies we're looking at. These aren't just businesses, they are sprawling empires, and they are absolutely locked in a strategic fight for global dominance.
And here's where it gets really fascinating. They're all competing in the same arena, but their playbooks for how to win could not be more different. I mean, they're polar opposites. One side is betting it all on global scale, while the other is betting on hyper-efficient, homegrown tech. So, the big question is, which of these models is actually built to last? Who's going to win in 2025 and beyond?
Okay, so here's how we're going to break this down. First, we'll set the stage, the state of the global protein war. Then, we'll dissect the two dominant business models clashing head-to-head. We'll look at who's winning on efficiency, map out their global footprints, and then, this is the important part, we'll show you how to spot the red flags, the value traps. And finally, we'll try to figure out who might just come out on top. You know, the old rulebook for the meat industry is basically being shredded. For decades, the name of the game was simple, just get bigger. But those days are over. Now these giants are getting squeezed by inflation, geopolitical drama, and changing tastes. The new battlefield isn't about size, it's about efficiency, resilience, and having a smarter strategy. Right at the heart of this whole conflict are two completely different philosophies about how you should produce protein. And if you can understand this clash, you can pretty much understand the entire industry. Okay, so think of this as the two warring factions. On one side, you've got the scale giants like JBS and Tyson. Their strategy is to go global, buying livestock from thousands of independent farmers. This keeps them flexible. Then on the other side, you've got the integrated tech farmers like China's Muyuan Foods. These guys are laser-focused on their home turf, and they own everything from the animal feed to the final product, so they can control every single cent of cost. Now that second model, it all comes down to this one key concept: vertical integration. The easiest way to think about it is, imagine a pizza restaurant, but they don't just buy flour and cheese. No, they own the wheat farm for the dough, the tomato farm for the sauce, the dairy for the cheese, and even the trucks that deliver the pizza. It is all about total, absolute control. So let's look closer at the scale giants. JBS actually calls itself a spread operator. Their profit is literally the spread between what they pay for an animal and what they sell the processed meat for. It's a fast game. They try to buy and process cattle in less than 24 hours to keep their risk low. But, and this is a big but, this model has a huge weakness. Just look at Tyson. When cattle costs suddenly spiked by almost $2 billion, their beef division's profit margin just cratered to -5%. Ouch. They absorbed the full shock of that price hike. Now let's flip to the other side. The integrated tech farmers have basically weaponized that idea of owning the whole process. Take Muyuan Foods in China. By controlling absolutely everything, they've managed to crush their breeding costs down to just $1.67 a kilo. It's incredible. Same with Shandong Minhe. They use advanced tech to control their entire poultry operation, which pretty much insulates them from the wild swings of the market. Okay, so you've got these two totally opposite models. How do we figure out who's actually winning the game? Well, in a commodity business, it almost always comes down to one thing: efficiency. The company that can produce at the lowest cost, using the fewest resources, well, they have the ultimate advantage. So let's pull up a financial heat map to really see this in action. We're going to use a metric that I think is incredibly telling: revenue per employee. Just think of it as a quick and dirty way to measure automation and efficiency. It really cuts through all the noise and asks one simple question: how much money are you making for every person you employ? And wow, this chart just lays that strategic trade-off bare, doesn't it? The scale giants, like Smithfield and Tyson, are way up top. They're generating over $400,000 per employee in their super automated plants. But then look at Muyuan. Their number is way lower. Why? Because their model of owning everything is incredibly labor-intensive. They have over 127,000 people on payroll. They are deliberately trading capital efficiency for that ironclad control over their supply chain. But hey, efficiency isn't just about spreadsheets and financials. It's also about geography. Where these companies set up shop creates these massive opportunities, but it also exposes them to some pretty unique geopolitical risks.
So let's take a look at how their strategies create two very, very different world maps.
So here's JBS, the textbook example of a scale giant. Look at this. Their revenue is spread all over the planet. About half from the US, almost a third from South America, plus big chunks from Australia and Europe. This is a classic global hedging strategy, right? If things are slow in one market, another one might be booming, which helps smooth out their overall performance.
Okay, now hold that image of JBS in your mind and look at this. The difference with Muyuan is, well, it's just staggering. 99.99% of their revenue comes from one single market, China. This is not a hedge. This is an all-in bet. They are betting the entire farm, literally, on dominating their home turf. It's a huge, profitable market, for sure, but it also carries a ton of concentrated risk.
And if you want to see what that risk looks like in the real world, check out this quote. This shows how Smithfield, a global player, got absolutely hammered by tariffs in China. See, geopolitical tensions can flip a profitable export business into a money-losing nightmare overnight. And that is exactly the kind of vulnerability that a single market player like Muyuan is built to avoid.
So, as we start looking ahead to the 2025 financial reports, what should we really be watching for? What are the warning signs, the so-called value traps, that could signal real trouble for either one of these models?
Let's create a quick cheat sheet. On the left, we've got the green flags, signs of a healthy company. We're talking strong cash flow from actual operations, not just accounting tricks, selling more valuable processed foods, and having diverse sources of revenue. On the right, the red flags, way too much short-term debt, writing down the value of bad acquisitions, and profits that look great on paper but aren't backed by actual cash.
Let's zoom in on a massive red flag for the integrated tech farmer model. So Muyuan generates a phenomenal amount of cash from its operations, over $4 billion. Great, right? But if you look at their balance sheet, they owe $5.7 billion in debt that's due soon, and they only have about $1.9 billion in cash. That's a huge mismatch. It creates this risk that if credit markets get tight and banks stop lending, they could face a sudden cash crisis, even though they're technically profitable.
And the scale giants? They've got their own red flags. Tyson recently took what's called a goodwill impairment of $343 million. Now, that's just a fancy accounting term for admitting that a company they bought in the past isn't worth what they paid for it. It's a big signal that their strategy of growing by buying up other companies might have led them to overpay, and now that bet is not panning out.
Okay, so we've seen the clash of strategies. We've looked at the efficiency numbers, the global maps, and the risks hiding in plain sight. Let's try to bring it all together and ask that big question. Which model is really positioned to be the protein champion of 2025?
When you strip everything else away, it really boils down to this one fundamental trade-off. The scale giants, the global players, they accept that their profit margins are going to swing wildly up and down. In exchange, they get a ton of financial flexibility. The integrated tech farmers do the opposite. They take on enormous risk by building everything themselves, but the reward is that ironclad control over their costs.
And that brings us to the final multi-billion-dollar question. In the world we live in today, with high interest rates that make debt expensive and global trade getting riskier, which bet do you take? Is it safer to spread your risk across the globe like JBS, or is it better to be the undisputed king of a single massive market like Muyuan? And think about this. What happens if an external shock, like a major animal disease outbreak, hits one of these models? There really is no easy answer here. Look, the debate over which strategy will win the global protein war is far, far from over. But now you've got the framework to understand what's really going on behind the scenes. If you want to see the complete data set and get a much deeper analysis of all 10 of these companies, you can check out the source for all this at hdresearch.com. Thanks for joining us.